and on Teams. So please make sure you're enrolled onto e-learning and on Teams. E-learning is very important because all your quizzes will be done on e-learning. Okay, so don't miss that. All right. So we looked at the initial measurement of PPE, but let us go and look at another concept that actually might complicate the measurement of PPE, and these are delayed payment terms. So when we talk about a delayed payment terms, this is where the payment is deferred beyond the normal credit terms. So for example, if it says that your credit, you must pay within 2 months, and then you pay, let's say after a year, okay, then that's a delayed payment term, okay? And normally the delayed payment terms, we're looking at a period of at least 12 months, all right? And so it's payment terms beyond the normal payment terms. In this instance, if that happens, there will be an interest portion that's involved, all right? And the difference between the cash price and the total payment that has to be made is interest. However, property, plant, and equipment should be recognized net of interest, and the interest will be recognized over the payment terms. All right, it might sound confusing right now, but an example will be able to illustrate this with an example. And let's look at this example. On 1st of January 20X6, a company purchased a machine at a cost of 2 million. The transfer of ownership took place on the same day, and it also became available for use then. The seller was willing to defer the payment of the purchase price until 31 December 20X6, while the normal credit terms would be 2 months from the date of transfer. Okay, so before looking at the other bullets, let's look at one important thing. The asset was bought on the 1st of January 20X6. Okay, it was bought on the 1st of January 20X6, but when is the payment supposed to be made? Only on 31 December 20X6. So that's already a full year after the initial date of purchase. So this indicates that it is a deferred payment. All right. So there will be an interest portion that is allocated in this amount. How do you think we would calculate the interest portion? Or what would you have to do to calculate the value of the PPE and then also the value of the interest? Anyone? Does anyone have an idea? What would you do? Okay, it seems that there's no idea what needs to be done. But what needs to be done here is to calculate the present value. You need to calculate the present value in order to get to arrive at the value of the PPE, the cost, the cash price of the PPE, and the difference is interest. We're told that the year end is 31 December 20X6, and you're required to prepare the journal entries to account for all transactions for the reporting period ended 31 December 20X6. So we need to prepare the journal entries to account for the transactions. Now, before we can prepare the journal entries, we need to do the calculations before we can actually prepare the journal entries. Okay, so since it's deferred payment terms, we have to calculate the present value. Can anyone explain to me what present value means? You should have already done this in quantitative methods. What is present value? I'm waiting. You can type in the chat if you are in the library or somewhere where you cannot speak. What is present value? I'm sure you know this. You have already done this last year. I don't want to pick out names, but you might force me to pick out names since you're not interacting. Class participation is important. I'm not here just to give you the answers, right? It's a learning process. We need to go through together. What is present value? Should I end the class now since there's no participation?
Say it's an amount of money today, it's worth more than the same in future.
Okay, repeat, Wilhelmina.
It's amount of money today, it's worth more than the same amount in future.
Okay. Anyone else?
Sir, it's like the value of something after it has like accumulated, like the value of something after it has like accumulated like interest after, like at that time.
All right. So I think what both of you are trying to say, it's the value of an amount today. The value of an amount today. All right. So if you think about it, this goes back to the concept of the time value of money. We say $1 today is worth more than $1 in a year's time or $1 tomorrow. So you'll always hear that, or even in your experience, 5 years ago, bread was a certain amount. Now the amount that you buy bread for, it's higher. So the value of your money has actually depreciated. And that is because of the concept of the time value of money. So $1 today is worth more than $1 tomorrow. Okay. So what you can get with that dollar today will be more than what you can get with that dollar tomorrow. That is the time value of money. So since we are buying the PPE, if you look at this, the question, we are buying the property, plant and equipment on 1st of January 20x6. So 1st of January 20x6 is the transaction date, but the payment will only be done at 31 December. That's after a year. The payment is only done after a year. But since we are buying it on the 1st of January, we have to record that transaction on the 1st of January. Okay. And obviously, because we're recording it on the 1st of January, the value of the PP on the 1st of January should actually be less than it is, or the amount of the value of the PPE will include a portion of interest because the final amount of 2 million must be paid at 31 December. So there's an interest portion that is included in the amount of 2 million. So how do you calculate a present value? We have to use the present value formula. And I'm sure you've already done this in quantitative methods. The present value formula, it's there. 1 divided by 1 plus r over to the power of n. So 1 that is just the number 1. R is the rate. Okay, that's the interest rate. And we've been given the interest rate. The current market interest rates for the year is 12%. Okay, so 12% expressed as a portion of 100 is 12 divided by 100. You're going to get 0.12. So that would be the rate. And n, so it's to the power of n. It's not multiplied by n. It's to the power of n. Maybe I should I couldn't show it to the power of n, but maybe I can show it like this. Let me try and insert that symbol. Okay, so that's to the power of n. N is the number of years, and in the number of years for this, for the purpose of this example, the number of years is 1. If you have a financial calculator, it's actually straightforward. What you're going to do is you're going to input the future value. So the future value is the amount that you're going to pay. So the amount that you're going to pay in December, which is 2 million. N, the number of years, N is 1 year. I, the interest rate is 12%, and then you would type or you would press on your calculator, compute present value. So once you do that, you're going to get a present value amount of 1,785,714. So this amount, 1,785,714, is the present value of the 2 million on 1st of January 20x6. Are we okay? Is that clear? The 1,785,000. Okay, so that's the present value at 1st of January 20x6. But and then the finance cost is the difference. Okay, the finance cost is the difference between the 1,785,714 and the 2 million, which comes to a finance cost of 214,286. So that's your interest for the year. The finance cost is just the interest for the year. However, let us go back to our question. The question told us that this is the part highlighted in yellow. The seller was willing to defer payment of the purchase price until 31 December 20x6, while normal credit terms would be 2 months from the date of transfer. Okay, so 2 months from the date of transfer. When is the date of transfer? The date of transfer, we're told, is 1st of January 20x6. It tells us in the previous sentence, the transfer of ownership took place on the same day and also became available for use then. All right. But since the normal credit terms are 2 months, right? Normal credit terms are 2 months. So if it was bought on 1st of January, they would have had to pay within 2 months. So they'd have the whole of January, and then they would have the whole of February to pay. They would have to make the payment by 1st of March. All right. So they'd have 2 whole months, January and February, to pay. But since they're paying on 31 December, then they've actually deferred the payment terms 10 months beyond the normal credit terms. Are we together there?
No, sir, repeat.
Okay, we are saying that the seller, the part highlighted in yellow, the seller was willing to defer the payment of the purchase price until 31 December 20x6, whilst normal credit terms would be 2 months from the date of transfer. So when would this machine be expected to be paid under normal credit terms? When would they have been expected to pay the machine under normal credit terms? That's my first question. when would the payment have to be made under normal credit terms?
March.
March, on 1st of March, right? Because that is 2 months after the purchase date. So under normal credit terms, they would have had to pay for the machine on 1st of March. But now they're paying for the machine on 31 December. So what is the period between 31 December and 1st of March? What is that period? How many months are there between 1st of March and 31 December?
9 months.
9 months from 1st of March. We'll count from 1
10.
March. So you have the whole of March.
10 months.
So it's 10 months.
10 months.
Yeah, so the payment was deferred for 10 months. So it means that the interest has to be allocated for 10 months. All right. So if we go back to our solution, we have already calculated interest for the year, but we can't say that this entity must pay interest for the whole year. Why? Because under normal credit terms, they would already get the 2 months that under the normal credit terms. So that doesn't form part of the period for which the interest should be allocated. So the finance cost of 200, that the total interest of 214,286 only has to be calculated for 10 months. That is why we take the 214,286 times the 10 out of the 12 months, and we get the finance costs that relates to the deferred payment. That amount is 178,572. Is that clear?
Sir, where did we
Sir, I don't understand.
Okay, sorry, someone asked a question first. Where did you get what amount?
the finance cost amount?
We calculated the finance cost amount previously when we used this present value formula to calculate the present value of the 2 million, and we came at an amount of 1,785,000. Then we said that the finance cost is 214,000. Let me go back. So this finance cost is the difference between it's 2 million. Is that 2 million? Okay, let me just do this. It's 2 million minus 1,700,000, 785,714. That is how we arrive at the amount of the finance cost for the whole year, which is 214,286. Are we okay up to that point in time?
Yes, sir.
Okay. Now we are saying that this finance cost is the amount for the whole year. So that's the interest that would have been allocated for the whole year. But we are saying that interest cannot be allocated to this company for the whole year. Why? Because under normal credit terms, they are supposed to pay within 2 months. So think about it this way. Let us say you buy something on credit. Let's use an example of electricity. Okay. So if you don't have prepaid electricity, then you get a bill from the municipality every month. Okay. So the bill for January will come sometime in the middle of February, and you have up to the end of February to pay for that bill of January, right? They give you about 30 days to pay that bill. So in those initial 30 days, they're not going to charge you interest because those are the normal credit terms. But if you pay after 30 days, then they'll start charging interest. Is that clear?
Yes, sir.
Okay, so
Yes,
it's
sir.
the same thing with this question. This question tells you that the normal credit terms is 2 months. So if you pay up to 1st of March, within those 2 months, you won't be charged interest. But after 1st of March, you're going to be charged interest. Okay? So now, what is the, how many months will you be charged interest for? You're going to be charged interest from 1st of March up to 31 December, which is 10 months. 10 months. And that is why we had to calculate all the interest that is applicable for 10 months. So we say that's 10 divided by 12. So you take the interest for the year 214,286 times 10 over 12, and that is how you arrive at the 178,000. Is that clear now? So that 178,000 is interest for 10 months. Maybe I should put it that 178,572, that is your interest for 10 months. The other 2 months is normal credit terms. You won't be charged interest for those 2 months. But why did we have to calculate interest for the whole year? Because when did this transaction take place? It took place in January, and your payment is only in December. So that December is already a whole year. It's 12 months after the date that the transaction took place. That is why we had to calculate the interest for the whole year. But since the normal credit terms tell us that we have to pay, we have 2 months to pay, they won't charge interest for the first 2 months, and then they'll only allocate interest for the next 10 months. Are we okay? Questions?
Yes, sir.
Okay. So now the next, what did the question ask us? The question didn't just ask us to calculate. The question asked us to prepare the journal entries to account for all transactions. Now, the easiest thing to do when you are doing this question, prepare the journal entry first. Okay? And which part of the journal entry? Prepare the credit part first, the 2 million. You know that that 2 million has to be credited. All right, so just credit your payable, and then you'll come and do this other, you will put the figures of the value of the PPE and the value of the interest later on after you've calculated it. But at least you can get your mark already for crediting your payable. Actually, it shouldn't even be. It shouldn't even actually be payable. Okay, but it doesn't tell us whether this amount was paid. But if it was paid, you're going to credit your bank. Okay, sorry, this is correct. You credit your payable because this is done on, this entry will be done on 1st of January. Let me just change this. 1st of January 20x6. These journals are all done on the 1st of January 20x6. Okay, so remember we say that it's done on transaction date. All right, so these journals are done on the 1st of January 20x6. So that's your date of your journal entry. That is why you credit your payable, because the amount wasn't yet paid on the 1st of January 20x6. Are we okay with that? We're still dealing with the initial recognition. Are we okay?
Yes, sir.
I guess we're okay. All right. So then your PPE will be debited. The amount of PPE is 1,821,428. And then the finance cost is the 178,572 that we calculated. So how do we get the 1,821,428? It's just the 2 million minus the interest. And that will be the value of your PPE on 1st of January 20x6. All right. So you should go and do this example again in gripping gap, right? Just to enhance your understanding. It's very important that you understand this concept. Okay. So next, let us look at barter transactions. Barter transactions, barter just means exchanging items. So in the olden days when money wasn't around, right, people would barter. So they would trade. So if you had, let's say you were a vegetable farmer, you were selling vegetables, and then you wanted to buy bread, and then there was someone who baked bread, for instance, then you could just exchange, right? You would give the person some vegetables, and then that person would give you bread, for instance. So that is what barter means, to exchange. So you can also do this for items of PPE. So you exchange one asset for another asset. Now, when this happens, since accounting has some rules, we cannot just ignore the transactions. There has to be a value that is allocated to those transactions. So at what value will you recognize the asset that you receive? At what value will you recognize the asset that you receive? So IAS 16 gives us guidance, and it tells us that you will recognize the asset that you receive at the fair value of the asset that is given up, or you have an option to use the fair value of the asset that is received if that is more evident. So if it's more clear that if the asset received has a more clearer value, for example, if that machine is traded in the market, but the machine that you're giving up is not really traded, so you don't have a market value, then in that instance, you'll use the fair value of the asset received to record the value of the asset that you're receiving. Alternatively, you can record the value of the asset received at the carrying amount of the asset that is given up. And this happens in two instances: if the transaction lacks commercial substances, and if the fair values of both assets cannot be reliably measured. All right, this is confusing just looking at the words as it is. I will explain what commercial substance means, well, as we go along, but this diagram will